Hi everyone, and welcome to today's webinar hosted by Ciphr. It's our tax year end 2025 payroll update. It's great to have you with us today. I'm joined by our regulatory analyst, Claire. Welcome.
Morning, Catherine.
And I'm also joined by Amanda Barndon, our sales manager. Amanda, welcome.
Thanks very much. Welcome, everyone.
Here's a quick look at the agenda. We're going to tell you a little bit about Ciphr in case you're new to our products, and Amanda's going to give you a 5-minute peek at our brand new payroll software, and then we'll hand over to Claire for the bulk of the webinar. She'll be running you through all the legislative changes that payroll teams need to know about for the tax year ahead. We will have time to take your questions at the end, so do use the Q&A function or the chat area to send in your questions and comments throughout, and we'll get back to you as soon as we can. If you're new to Ciphr, here's a look at how our solutions and software fit together. We have a range of solutions that cover the whole employee lifecycle, including our brand new payroll software that I mentioned, as well as benefits provision through our recent acquisition of Avantus, right the way through to off-the-shelf and customizable e-learning courses and DEIB consultancy. We won't go into all of those solutions now, but if you want more information, feel free to contact us at info@ciphr.com or visit our website, which is ciphr.com. And with that, Amanda's going to give you a quick 5-minute overview of our new payroll software. Thanks, Amanda.
Thanks very much. So let me share my screen and we can have a look at Ciphr Payroll, our brand new cloud payroll solution. So there we go. Catherine, could you just confirm that that's come up on the screen, okay?
Yes, that's fine. Thanks, Amanda.
Great. Okay, thank you. As promised, it's just going to be a really quick whiz through. If you want to have a more detailed look, I'd love to spend more time with you, but let's have a quick look at what we've got here. So it is a true API-led cloud payroll solution with real-time net pay calculations. So you can see here it is a multi-company system. You can set up as many PAYE schemes as you like. And within a single PAYE scheme, you can run multiple frequencies of payroll. On our dashboard here, you can see the status of each of your payrolls and your RTI submissions. We can see the full details for any of the RTI submissions at any time. So we can just tap on these and view the detail. Okay. I'm going to really briefly take you through what an employee record looks like, and then let's pay somebody and we can have a look at a couple of reports, and then I'll hand back to Claire so that we've got the main focus of today is on those legislative changes that you all need to know for the coming tax year. So in my employee records, and we've got a dashboard for the employees, so everything that you need to see for each of your employees at a glance. So their name, address, date of birth, date of joining, their tax details, their bank accounts, all of that information is there. We can see their pay details. We will build up a salary history here as well, and their contract hours. Any absence data, so sickness, maternity, paternity, bereavement, and so on. We can see their payslip history, their pensions membership. We have an API integration directly to Nest. We'll be building more of those over time, but we can also create interfaces to all of the main pension providers in the UK. We're all set to go for payrolling benefits in kind. So I'm sure a lot of you are doing this already or just about to start from the April 25. Everyone's got to do this from April 26, of course. So if you're thinking about moving and perhaps that's difficult for you on your current payroll software, again, do come and talk to us. Diving into the pay run, I've got an open pay run so that we can see the calculations. But I can also see my previous pay runs. So if I wanted to see any of the data, rerun old reports or old pensions, previous pay slips, I can see that for any previous pay run. Going into the current run, let's choose an employee record. Let's pay Harry a little bit more. So you can see we've already got a gross to net calculation. So when we open the tax period, within a second or two, you're going to have gross to net pay for each of your employees. If I add a payment, perhaps we're going to add some overtime for this colleague. Let's put in a number of hours, save that entry. And we can see immediately that there's a new gross, we've got a new net. If I have a look at Harry's payslip, I can see that coming through. I forgot that's not going to come through on the PDF download, beg your pardon. But you can see again that we've got that new gross to net, and we can follow that all the way through to our summary and our pay elements report. Okay. So from that point onward, when you're balancing your payroll, obviously you can create much more reporting, journal exports for your finance system and so on, and again create the RTI submissions directly from the system. So that was a very quick run through. There's so much more there that I would like to show you, but I know you're keen to hear what Claire's got to say today, so I'll stop sharing my screen now and I'll hand back to Claire so that we can run through the rest of the webinar together.
Thanks, Amanda. That's almost like a little bit of a teaser.
Well, I hope so.
Just wait for those other slides to come back up. Thank you. Right, so as Amanda said, we're now going to get into the meat of this session. Nice to have a little teaser of what's coming and what's new, but let's have a look at all the stuff that's coming for us in terms of legislation. There's a lot going on, and there's a lot of moving parts at the moment. So bear with us as we go through this. So we're going to look at minimum wage, living wage, tax, national insurance, all the normal stuff that you would expect us to be covering on a year-end update. There's some new stuff, so neonatal, there's a bit more detail on neonatal that we'll include here. And we're also going to have a look at what's coming for 25, 26 and 26, 27. So there's, as I said, lots and lots for us to keep our eyes out on for. Payroll is not going to be sitting still this year. So national minimum wage, these rates were announced some significant time ago, but they are quite substantial increases. These rates apply from the 1st of April. So yeah, that's less than a month away. And some of these rates are increasing up to 18%. So apprentices and 16 and 17-year-olds are increasing by 18% up to £7.55 per hour. 18 to 20-year-olds are going from £8.60 to £10 an hour, which is a 16.3% increase. And anyone over 21, which becomes the national living wage, is going up to £12.21. The accommodation offset has also increased to £74.62 a week. Now, do watch out if you pay at these type of levels. If you have salary sacrifice schemes in place, there could be potential with these levels of increases that you might need to review those, but we'll come on to that in a little bit. So those are the new rates, and also we need, and I'll mention later, to watch out for, there is still rumour that these bandings will be disappearing over the next few years. So again, watch this space on these ones. So then we all know about income tax, Theo. So what's not happening? It's not the tax and NI thresholds are not changing. They are frozen until April 28, and that has been confirmed. They're not changing at all. So the standard tax code, excuse me a second. Sorry. sneezing, coughing. It's not healthy. So there's no change to the tax code. The standard tax code for everyone is 1257L for all areas, and that includes Scotland. The personal allowance income limit remains at £100,000. There's been some minor changes to the married couples allowance. The marriage allowance remains the same, and the blind person's allowance has increased by a whole £8. But again, chances are you're not going to know any of those things in terms of rates, because it will all be included in tax codes and stuff like that. So not necessary for us to particularly worry about within payroll, but it's useful information. The tax thresholds for the UK, so that covers the England, Wales and Northern Ireland, with the exception of Scotland, no changes. The rates remain the same and the thresholds remain the same. So nothing different there at all. And then if we move on to Scotland, well, they like to be a little bit different, and they like to keep us on our toes a little bit. So their percentage rates remain the same, but they have changed the starter, basic and intermediate tax bandings. So the starter rate has increased to £2,827 as a maximum from £2,306, highlighted on this slide in yellow. The basic rate now goes up to £14,921. Previously, that was £13,991. And the intermediate rate has actually reduced in size. So instead of it being 13,992 up to 31,092, the 3192 remains the same, but the threshold has effectively reduced, because it now starts at 14,922. The remaining higher, advanced and top rates do not change. So there is nothing to change there. So it's the lower rates will have a slight impact on taxable pay for those Scottish taxpayers. And then a hot potato that's been flying around for a little while now, national insurance. So we know there's been some changes to national insurance, but only 2 of the thresholds have actually changed. So the LEL has increased to £125 or £6,500 a year. Previously, that was £123 and £6,396. But the biggest change for us really is the secondary threshold, which is actually the employer's threshold. For the first time ever, the secondary threshold, or ST, is below the LEL. Now, this means that employers are going to be paying significantly more national insurance. So last year, the national insurance for employers didn't start until an employee earned £175 a week. Now that is going to be £96 a week. So quite a significant reduction. The annual figure is from £9,100 down to £5,000. This is going to have an impact on bottom line, on costs for employers. And we're already feeling that piece of change coming through with budget changes, with national insurance changes, and with minimum wage changes. Employers are finding that costs have gone up significantly for them. So do watch those. And it's worth noting that if you're running payrolls for other organisations, they may well be questioning why their employer's national insurance has gone up so significantly. The other reason, of course, that it might just be going up is the increase from 13.8 to 15%. So again, not an insignificant increase, but still lower than we've had historically. But coupled with everything else, quite a big change. So I've highlighted on this slide the where the changes have occurred. But also we need to remember that Class 1A and Class 1B rates are also increased to 15%. So again, previously 13.8%. So they've taken a little bit of a hike as well. And then any of the employers that might be claiming for Freeport or investment zone relief, the top end of that has also increased to 15%. So they haven't escaped. They do still get the relief at the lower rates, but obviously once it gets to those higher rate areas, the cost goes up. There is something else also on investment zones and Freeports, and we'll come on to that in a little bit. So basically, across the board, national insurance going to be a bit of a hike. Everybody's going to notice that there's a difference in their costings from April. To counteract some of that, and it won't counteract all of it, but the government's aim to counteract some of it is a change to the employment allowance. And something I've forgotten to mention, and I will mention now, is I was contacted earlier in the year with somebody from a public sector organisation, NHS actually, but for any of the public sectors, there was a really confusing statement in the budget that said the national insurance increase will be offset for public sector, because public sector can't claim the employment allowance. Now, some people took that as meaning there would be two sets of tables, two rates of national insurance. That is not the case. There is still only the one rate of national insurance, and the offset costs will be funded through government budget payments back to local authorities, the NHS, etc. What does that mean for other companies that can claim the employment allowance? Historically, there has been a threshold of £100,000 where employers whose national insurance liability was over £100,000 weren't able to claim this. That's now been removed. So all employers, assuming they are able and eligible to claim the employment allowance, can now claim £10,500 a year from April 2025 to help towards the increased national insurance costs. The criteria for claiming remain unchanged apart from the upper limit. So everything else remains the same. However, you may need to check within your software that there's something or nothing that you need to do in order to be able to claim this. So just check with your software providers if there's a different button that you need to tick that's hidden in the settings somewhere. And let's face it, if we can get £10,500 back off the government, why would we not? That's going to help offset our increased costs. Now we're moving on to statutory payments, and as with every year, there are some increases in statutory payments, which we would expect. So the parental leave ones have increased from £184.03 to £187.18, or 90% of the average weekly earnings, whichever is the lower. So that covers maternity, adoption, paternity, shared, parental bereavement pay, and the new neonatal care pay. So all of those will be at the same rate. Statutory sick pay has increased £2 a week from £116.75 to £118.75. Now, these come into effect from the 6th of April this year. Hurrah, the 6th of April falls on a Sunday, so we don't have to worry about the date being different. So that's a bonus for us this year, but those are the new rates from then. Also remember just to check that I have no idea where I was going with that statement, so I'm just going to ignore it. My brain has gone completely. So forgive me. Let's go on to the small employers relief. So again, no change in terms of accessibility for companies. However, for the first time since 2011, the rate has increased. So previously, it's been 3%, or we would know it as we were able to claim back 103% of our parental leave payments. Now we will be able to claim 108.5%. So again, that's quite a significant increase. That's an extra 5.5%. But it's been a long time coming. 2011 was a long time ago. So again, small employer is still defined where their total NI contributions were £45,000 or less in the last complete tax year before the employee's qualifying or matching date. So that hasn't increased at all, but the compensation rate has. So again, something else to take note of. Statutory sick pay, this table provided by the government very kindly gives us the daily rates for SSP calculations. So as you can see, if somebody works a 5-day week on here, we can see their statutory sick pay is £23.75. And if they work a 4-day week, it's £29.69. Those are both per day rates. All of it equates through to £118.75 a week. So what have we got in terms of other changes then? So let's have a look. Student loans. Let's start with those. There are some changes, again highlighted here in yellow. Plan 1, the threshold has gone up to £26,065. Plan 2 has gone up to £28,470. There's no change to the postgraduate loan, which remains at a £21,000 threshold. Plan 4 for Scotland has increased to £32,745. And Plan 5, which is introduced from April 2026 for England, relates to new students that started studying on or after the September 2023, has been announced as a threshold of £25,000, but a rate of 9%. No rates other than that have changed. So they all remain static in terms of the amount they're paying. It's just the thresholds that's changed. Scottish arrestments, Scottish earnings arrestments. Well, they've given us a bit of a surprise this year. These are usually reviewed every 3 years, last reviewed in 2023. So we weren't expecting anything this year. However, just to keep us on our toes, we have changes coming in effective from the 6th of April 2025. The new rates and bandings are shown below on that table. So again, just double check that you're aware of those changes, and if you are processing any Scottish earnings arrestments, any increased contributions will be due to the change in these tables. The official rate of interest for 2025-26, that remains at 2.25%. What's it used for? It's used to calculate the tax for employment-related beneficial loans and some employment-related living costs. Now, historically, if we go back to 2000, January 2000, the government made a commitment that they would not change that rate during the year. However, in the autumn budget last year, the government ended that previous commitment and have now told us that effective from the 6th of April this year, the ORI may increase, decrease, or remain the same throughout the year. The rate is going to be reviewed quarterly, and the rate changes, if there are any, will take effect from the 6th of April, July, October, and January. This could cause us some challenges in terms of calculating beneficial loans and some employment-related living costs. So we use this rate to calculate the benefit in kind, for one of a different phrase on these. Now, if that's going to change potentially every 3 months, we could be forever revising those taxable benefit calculations. Strangely, or maybe because those two items, beneficial loans and employment-related living costs, are the ones that are excluded from payrolling as mandatory next year. So you can do it voluntarily, but they are actually excluded. Future changes on this will be published on gov.uk, which is exactly where you would expect them to. But we just need to be aware that if we are payrolling those particular benefits, we need to keep on top of those potential interest rate changes. Something else for us to keep our eyes on. Advisory fuel rates, well, they changed from the 1st of March. They are revised quarterly, or have been for forever and a day, as far as I can recall. But of course, they're different quarters than the official rate of interest we'll be using. So here we've got changes from March, June, September and December, just because we like to be different and do something at a different time. These rates apply for employees that are using company cars when they're either reimbursing business travel in company cars, or they need to repay their cost of private travel through company cars. There are only 2 changes from December. So the 1401 to 2000 cc petrol has increased from 14 to 15 pence from the 1st of March. And for diesel, the up to 1600 cc vehicle has increased from 11 to 12 pence. Electric cars rather, remains at 7 pence per mile. That was last changed in September last year. And again, it's something just to keep our eye out for. These changes, they're not unusual for us, but with the changing costs of fuel, they can change quarterly, as I said. So, going to take a deep breath now. We're going to look and take a dive into Neonatal Care and Leave Act 2023. It's new, it's coming in with effect from 6th of April 2025, was confirmed by the government in January this year. And as the Act title would indicate, this became legislation in 2023, so it's been around a while. It's just not been implemented as yet. So this will apply to babies born on or after the 6th of April this year. There's no, we can't retrospectively calculate it. So any baby born on the 5th of April even will not qualify for this. The entitlement is triggered where a child enters neonatal care within 28 days of their birth. If they enter neonatal care after 28 days from their birth, neonatal pay cannot be claimed. So to qualify, the child has to enter neonatal care within 28 days of birth and complete a minimum consecutive 7 days in neonatal care. Like other neonatal, unlike other parental leave, neonatal care and leave is a day one right, but pay requires continuity of service and the employment earnings test. That's nothing new for us. However, the other big difference is that it's earned in arrears, because you don't earn it, you're not entitled to it until that child has been in neonatal care for 7 days. So you can't take the first 7 days as neonatal care because there's no entitlement to it yet. So there are a couple of options. The employer could just give you that leave. You could take emergency family leave. You could take other statutory leave, such as paternity leave. You could take annual leave, which can't be forced. You may already be on maternity leave. So there are other options that can be used for that first 7 days. However, it's also available to both parents, and it's in addition to every other type of parental leave. So it has to be taken in increments of 1 full week at a time, and you can be entitled to a maximum of 12 weeks. So if your child is in neonatal care for 12 weeks, you get 12 weeks of neonatal care. The taking of the leave and the pay is separated into 2 tiers, and I'm going to explain those in a minute. Final guidance, well, we're still waiting on full guidance from HMRC, so there's a few little edge cases that we're not 100% sure on yet. We are waiting for final answers. They're still telling us it will be published. I'm hoping it'll be published before April, but we'll see. We have no control over that, so we'll deal with it as it arrives, as payroll usually do. The other thing to watch out for is this applies to Great Britain only. There is no legislation for its introduction in Northern Ireland. So if you are paying employees that are resident in Northern Ireland, you need to be very careful if this is claimed. Hopefully it won't be, and hopefully people won't need to use it, but just worth flagging that it isn't legislation in Northern Ireland at this point. So what's the data required in terms of sharing information with your employer in order to be able to qualify for neonatal? You have to have the employee's name. Well, that's fairly obvious. We need to provide the child's date of birth, if applicable, or their placement date if they were adopted or were being placed. The date the child started receiving neonatal care, or each date if it's a multiple. The date the care ended, if indeed it has. It might not, it could still be in an ongoing situation. The employee needs to make a declaration that they meet the parental relationship criteria, as for the same declaration as for paternity leave. And that's required if it's the first time that they're giving notice. And the employee has or intends to care for the child during the period of leave that is being taken. So far, there are no formal government forms equivalent to SSP1 for an employee to complete and sign. My recommendation would be that within an organisation you have something that you could share with your employee if they were in this situation, so it's quick and easy for them just to fill out something and email it in, a template of some sort. Because if they are dealing with neonatal care within 28 days of a child's birth, they aren't going to be thinking that clearly around what they need to do to communicate with their employer. So I've mentioned tiers 1 and tiers 2. So let's have a look at what that actually means. Tier 1. So the notice must be provided to the employer before the employee's start time of their first day of absence, or as soon as reasonably practicable to do so after the child's admission into neonatal care. The notice must be received within 28 days of the start of leave. I'm fairly sure that that would happen anyway. So what about the leave in tier 1? Well, as we've mentioned before, the entitlement is gained retrospectively. So leave is available whilst the child is receiving neonatal care and the week following their discharge from the care, but it can't be taken in the first part because you won't have earned it. Again, it must be taken in blocks of a week, but there's no limit on the number of blocks other than the maximum entitlement. But the one key thing here is if the leave overlaps with pre-booked parental or other leave, neonatal can be paused and taken at a later point. So unlike other parental leave, it's not easy to pause those, but with this one, it can be paused and it gets added on to the end of the leave period. When we move to tier 2, we need to give a week's notice of, sorry, my brain isn't with me. So for 1 week's leave, you need to give your employer a minimum of 15 days notice. If you want 2 weeks of leave or for more than 2 weeks, that notice period is capped at 4 weeks. So the employer is never going to get more than 4 weeks leave, 4 weeks notice of somebody taking leave. And the notice of pay must be given within 28 days of the start of the leave period. So exactly the same as tier 1. Tier 2 leave covers any period which isn't covered by tier 1. So it's a catch-all. It's available from the 2nd week following the child's release from neonatal care, but can be taken up to 68 weeks following the birth of the child. It can be taken as one continuous block of 10 weeks, for example, or it could be taken in blocks of 2 or 1 week at a time. Except when we get to tier 2, it has to be taken as a continuous block. So you could have taken 2 weeks under tier 1 and still have 10 weeks entitlement. That 10 weeks at the end is tagged on to the end of whatever parental leave you might have taken. So if that's an employee who has taken their 52 weeks of maternity leave, they can then tag on another 12 weeks potentially of neonatal. So again, taking us up to 68 weeks. It's a long time post-birth and it covers more than 1 tax year. So we need to consider, record keeping and stuff like that. So if there are any questions on neonatal, I will do my best to answer them. But as I did say earlier, we're still waiting on some information to come through. So what about the next steps? What does that mean? What else have we got to consider? So for some organisations, it might be prudent to prepare some cost examples around employees for those setting budgets, things like the changes to minimum wage and the national insurance changes. Particularly if you missed the change to the Class 1A cost, Class 1B costs. Under the Alabaster ruling, and we all love a bit of Alabaster to complicate our lives, the national minimum wage change constitutes a pay rise. So you need to review those calculations just to double check that there's no additional entitlement. And consider the impact, as I mentioned earlier, on salary sacrifice or OPRA schemes to make sure that you continue to be compliant. Under the other changes that are being introduced this year, workplace postcodes are going to be a mandatory requirement for the RTI return for any employers claiming Freeport or investment zone relief. So that data has to be in your system as a workplace postcode before your first RTI submission of the new tax year. So it's worth gathering that data now. Otherwise, that will actually reject your RTI submission. we need to be thinking about and preempting almost, or putting in our diary, the spring financial statement, which is due out at, I think from memory, it's the 26th of March. But let's have a watch and see what's coming out through that. We already know there's some teasers coming out this week already about potential changes and some updates to the Employment Rights Bill. For example, we know that there's going to be a change on miscarriage leave. That will be a change to the bereavement leave legislation. So it won't be new, it will be a change to bereavement leave. We know that there's going to be some SSP changes, for example, and I'm going to come on to that in a little bit. And during 2026, what else are we expecting? You know, Amanda's already mentioned benefits in kind. They become mandatory from April 2026. So start your preparations, look at what you need to do. You might already be doing it, but what you might not be aware of is that Class 1A will become a monthly liability from April 2026, rather than the annual liability that it currently is. Worth pointing that out to those responsible for budget planning, because that could have a significant impact for them. So we also know that parental leave is under review, paternity and other parental leave to be considered as a day one right. But what else they are looking at, we don't quite know right now, but it is under consultation. So it's not going to be a quiet year for us. There's lots of stuff for us to consider. There's a bit more about benefits in kind reminders, what's going to happen, what we need to worry about. Employment related loans and accommodation, as I've already mentioned, are excluded from the mandatory requirement to payroll. But we will be having a new mini P11D, P11DB to deal with those. And very kindly, having got rid of all of our, or the majority of our end of year routines, we're now having a new one introduced to deal with the benefits in kind and any recalculations that might be required to ensure that the correct amount of tax has been collected. So again, things that we might need to be considering there. What do we need to know? What data might we need? Do we need to communicate with our employees? What's the impact to them if we're not already payrolling? Are they going to be double taxed? All of those sorts of questions are likely to be coming through if you're not already payrolling. Certainly worth having a look. And then the SSP reforms I've mentioned a couple of times. It's now been confirmed that there will be the removal of those waiting days and payment of up to 80% of wages for those earning at or below the LEL. So that's a significant change. SSP has been around since the early 80s with very little significant change. That is a major change. The statement, I think it only came out yesterday, was it may change later this year. I'm really, really hoping that they leave us until April next year. We can do without another in-year change, but we've got no guarantees at the moment. We've got 0 hours contract changes, reporting for gender pay gap and ethnicity. There's the removal of age bans, carers leave reform, single worker status are all being thrown around at us at the moment. There is an awful lot that is coming our way. I mentioned the change to bereavement leave for pregnancy loss before 24 weeks. We are expecting that to be coming through this year. But the one thing that has been dropped is the right to disconnect. So the employee's right to disconnect from work outside of working hours has been dropped by the government as too complex and too much of a burden for employers. So I guess I don't know if that's a positive or a negative. hopefully it's a less of a burden for employers to manage and control, but it does mean that, you know, good employers don't expect their employees to be online 24/7 anyway. That's just, yeah, everybody needs a break somewhere along the line. Refresh the batteries, or in my case, make my brain work, do a bit of filing in my head. So we have come to the end of that particular update. Hopefully you found that useful. I believe there's some questions, and if we don't have time now, I will happily log on and sort those out. But yeah, thank you very much for staying with us.
Thanks, Claire. I will give your voice a little tiny break while we just have a look at the questions that have come in. We won't get much of a reprieve, I'm afraid, but we've got some questions coming in about SSP. We've got some, oh no, not SSP, neonatal care. We've got some questions about P11Ds. So the one that's got the most votes is neonatal care. Is the 12 weeks available to both parents each?
Yes.
Okay, that's an easy one.
That was easy. Yeah, I can do that one.
Perfect. And Joanne asks, when setting up payrolling benefits in kind for the first time, will there be a double taxation for the employees it affects, as in a tax code change for P11D the previous year and then BIK payrolled currently in real time?
Yeah, potentially. Yes.
Potentially. Cool. And then that all comes back to communication with employees about what's going to happen. I think on previous times we've discussed payrolling benefits in kind. It's all about engaging people and making them aware that change is coming. It's not just a payroll change, it's a payslip change.
Yeah, and actually for a lot of companies, they are moving away from some of the P11D stuff for company cars, for example, and going to car allowances, just because those costs now are going through the roof in terms of they're liable for class 1A on them as well.
Okay, great, thank you. Question from Becky, is there any clarity yet on when it will be possible to payroll the director loan benefit in kind rather than P11D, or how this will work?
No, we've got no clarity as yet. The government are promising us guidance on payrolling of benefits by December, which is a bit late when it's coming into effect from the following April. Hopefully that will include answers to questions like that. But at the moment, no, there's nothing that I could point you to.
Okay, thanks, Claire. I think this is a related question from Sabine. How will benefits in kind be calculated when a director only receives a company car benefit but no salary? Can it be payrolled? No. If there's no salary going through, you can't benefit. No, you can't tax something. You can't have negative. It'd be a positive tax because tax is negative, but no, you'd end up with a negative pay slip. So no, you can't do that, I'm afraid. Okay. No guidance as to what will happen for those people either. I'm guessing it just remains the same. Okay, thanks, Claire. And another P11D one from Sarah. We still have to process P11Ds as we have living accommodation, but payrolling benefits also for private medical. Does that mean that the class 1A NIC will be paid across monthly, and then an amendment again after the P11Ds have been submitted?
Yes, to the class 1A monthly. Part of the new year end routine will be to recalculate. We believe will be to allow recalculation for adjustments that are required. So we've yet to get full details on what that new end of year routine will be. But yes, there will be changes like that.
Okay, thanks, Claire. That's the end of all the questions that we've had so far. So I'll give you, everyone watching, another 30 seconds to send them in. Otherwise, we'll wrap up for this session. I think the thing with payrolling benefits in kind, as Claire's mentioned, is there's loads of unknowns. There's loads of known unknowns, to use a common phrase. And we will be revisiting the topic when we have some known knowns, basically, later in the year.
I think I'm going to be living this topic for the next year.
Yeah, exactly.
Yeah.
So that looks like all our questions for today. Thanks everyone for joining us. We really appreciate you making this time. If you're watching live, this will be emailed to you shortly, so you can watch again or share with a colleague. If you'd like to learn more about our solutions, you can opt in using the exit form on your screen when this broadcast ends, or by emailing us at info@ciphr.com. Thank you again, Claire and Amanda, for sharing your expertise today. We really appreciate it. Thanks everyone for joining us. We hope you found this useful and informative, and that we'll see you again at another Ciphr webinar soon. Take care. Goodbye.
Bye. Thank you.